The Swissy, the Greenback, the Loonie, the Aussie, we love currencies so much, we even give them nicknames. But how do currencies impact our investments? And how can you invest in currencies? Welcome to this fascinating episode of How to Invest by Julius Baer. Who doesn't love the feel of money in their pocket? We use it every day, either electronically or in paper form, to buy goods and services. And holding that banknote in your hand means the central bank of that country and its institutions have guaranteed its value. As a Swiss resident, when I go to another country on holiday, I exchange my Swiss francs for another currency. And when I do that, I pay an exchange rate. This changes day to day depending on the supply and demand of that currency. Sometimes it's a nice surprise when you get more than expected in a currency exchange. Then I can go off for a nice holiday, safe in the knowledge I can buy as much ice cream as I want. But buying and holding that currency, either for spending on holiday or holding in a bank account for a rainy day, is one thing. Investing using currency is another. I might take my Swiss francs, for example, and exchange them for euros to buy a house. Then the asset is the real estate and not the currency itself. Or I might exchange my Swiss francs for dollars so I can buy a US-based fund or stock. Here, I pay the exchange rate to change my francs to dollars before I buy. And while I might make a few percent on the fund, depending on performance, I might lose some of that return, changing the dollars back to Swiss francs when I want to close out the investment and access the money. And that's because currency rates change all the time. The foreign exchange market is the biggest financial market in the world, bigger than stocks and bonds combined. But predicting where a currency is going to go day to day is very challenging. So how could I protect myself against this uncertainty? Well, one thing I could do is hedge against that potential change in value against my home currency. So at the same time as I exchange my francs to dollars to invest in that US fund, I also agree to simultaneously sell the same amount of dollars in an opposite trade. Therefore, I have no exposure to any movements in one currency against the other, like the balancing of scales. This is typically done through the forwards market. This market is where you can take exposure or eliminate exposure to one currency against another without actually needing to hold that currency, which is done through leverage. And this is fascinating. You only need to hold 10% of the amount you want to trade as collateral. Let's take an example. Remember that US fund I bought into? Well, say I put $1 million into it, leaving me with very few Swiss francs back home. But I do have 100,000 Swiss francs, and I can use this to sell $1 million through leverage. Because I only need 10% collateral, this is possible. The rest of the money comes from the bank, which allows me to make this trade using my 100,000 Swiss francs cash to secure the position. Think of it just like a down payment secures a mortgage on a property, but of course without the monthly payments. At the end of the term of the forward trade, and if the underlying investment in the US fund is still in existence, I would then roll that hedge over again for another fixed term. This is called a swap, and it allows me to maintain the protection against currency fluctuations. Of course, you can also do this not as a hedge with an underlying investment, but also as speculation. But then you would be taking on a risk that the dollar, as in my case, goes up against the franc. And as with any leveraged investment, you could lose your collateral. And for some, that would mean some pretty sleepless nights ahead. Check out our other episodes on how to invest by liking and subscribing to the Julius Baer YouTube channel.